Nobody tells you this, but somewhere in your family tree, there's a great-great-grandparent who never once paid a bank a single dollar for the privilege of keeping their own money safe. Not one overdraft fee, not one monthly maintenance charge for a checking account that did nothing but exist. They just kept their money, successfully, for decades, with a jar. And you? You have a banking app, a Face ID login, a customer service chatbot named Aiden, and somehow you still got hit with a $35 fee last Tuesday for the horrifying crime of having $34. So today, we're going backward, way backward, before banks, before the FDIC, before your bank could sell you a premium checking account that is neither premium nor checking anything. We're going back to the original system Americans used to protect their savings without banks, a system so simple, so nearly foolproof that modern financial experts are quietly bringing it back and just not telling you, because a version of it doesn't charge fees, and fees are how they afford the free pens. Here's the part that should make you deeply uncomfortable. This primitive system had a lower failure rate than the actual banks that later replaced it. Multiple banks collapsed in the 1800s and early 1900s, repeatedly, spectacularly. People lost everything overnight because they trusted an institution instead of a system. Meanwhile, the guy with the coffee can under the floorboard, he was fine. Today, we're going to walk through exactly what that system was, why it worked, how a modern version of it is quietly outperforming savings accounts right now, and a 7-day challenge to start using it yourself. No history degree, no financial jargon, no pretending you understand what a variable APY is when you very much do not. Before we go further, a quick thing. If you're the type of person who has never once looked at where your paycheck actually goes, hit subscribe. Not because it'll fix your finances, it won't. Subscribing has never once balanced a checkbook, but the algorithm rewards loyalty, and clearly loyalty to bad habits is a skill you have already mastered. Like the video too, it's free. Unlike the convenience fee your bank charged you for withdrawing your own money from their own machine in their own building using your own card for a transaction that took 4 seconds and apparently required a full team of engineers to process. All right, welcome back to class. Pull up a chair, or don't, since after this video you may reconsider whether chairs, and furniture in general, are a wise use of borrowed money. Today's lesson covers 3 real historical terms: the mattress method, the sock drawer standard, and the granddaddy of them all, the mutual aid system. Here's the truth nobody puts in a finance textbook. Before 1863, there wasn't even a unified national currency, let alone a nationwide banking system anyone could fully trust. So Americans built something else. They built systems that didn't rely on trusting a stranger in a suit behind a marble counter. They relied on trusting each other, trusting a really good hiding spot, and trusting the basic principle that money you cannot easily spend is money you will not spend. And here's the twist that's going to sting a little more than the last one. This outdated system had lower fraud rates, 0 overdraft fees, 0 maintenance charges, and it functioned completely fine during actual banking collapses. Meanwhile, your very modern bank charged you a maintenance fee last month for maintaining absolutely nothing. This isn't a nostalgia video about quaint habits. This is closer to a heist video, except the thing being stolen is your money, the thief is your own banking habits, and the getaway vehicle is a subscription you forgot you signed up for and have paid for every month without using. So, here's exactly what you're walking away with today. Number 1. The actual historical system Americans used to protect their savings without banks, and why a modern version of it is making a comeback. Number 2, how that system works today, why some financial experts consider it safer than a traditional bank account, and how you can start using a version of it this week. And number 3, a simple 7-day challenge. No spreadsheets, no complicated apps, no pretending to understand financial jargon you don't actually use. Think of this less like a history lesson and more like an intervention hosted by your most brutally honest, weirdly well-informed ancestor who somehow retired debt-free without ever using a banking app. Now, quick pause. If you're sitting there thinking, I genuinely do not understand money at all, that's normal. That's exactly why the eBook exists. It's called Finance Literacy for Beginners. No jargon, no shame, no assuming you already understand terms people throw around casually.
It walks you through budgeting, saving, and debt in plain language, and the link is in the comments. It's cheap, it's fast to read, it won't judge you for overdraft fees. Go get it, come back, and let's continue, because the system Americans used before banks is about to make your current emergency fund look very concerning.
Here's the problem, and I want you to actually sit with this one because it's bigger than your ex's commitment issues and considerably better documented. The modern banking system was never built to protect your money. It was built to hold your money in exchange for the illusion of safety, then quietly charge you for the privilege. You didn't sign up for a partnership, you signed up for a system that uses your money while giving you very little in return. Let's talk numbers, because sarcasm is fun, but receipts convince people. The average checking account earns an interest rate so small it is mathematically closer to 0 than it is to 1%. Meanwhile, inflation moves at 3 to 4% a year, which means your money, sitting in your bank account, is quietly losing value every single day. You are not saving money, you're watching money lose value in slow motion while being told your balance looks fine. And here's the part that should really annoy you. Banks do not even keep your money. They lend it out multiple times over to other people for profit. You deposit money and the bank uses most of it elsewhere while paying you almost nothing in return. It's not really a saving system, it's a system where your money is working, just not for you. This is not a conspiracy theory. This is how the system works. It's just explained in a way that makes it easy to ignore. And yet, you'll spend time arguing over small charges but not spend a few minutes understanding how your money is actually being used. So here's the actual problem in one sentence. Banks profit from your money moving through them, and you profit very little from letting it sit there. That is the entire relationship. Now here's the main idea, the whole reason we went back in time. The system Americans used before banks wasn't just hiding money, it was built on something smarter, mutual aid. Neighbors and communities pooled money into shared funds. When someone needed help, a crisis, an emergency, the group supported them. No interest, no fees, no credit checks, just trust and structure. The modern version of this exists today in forms like credit unions and community-based financial systems. These are built for members, not for profit targets, and they often offer lower fees and better returns than traditional banks. But even that isn't the full picture. The real principle behind those systems was not just where money was kept, it was how difficult it was to access it. When money is harder to reach, you spend less of it impulsively. When it's one cap away, it disappears faster. So the main idea is simple. Older systems made saving automatic and spending difficult. Modern systems made spending easy and saving optional. That single reversal explains why many people earn money but struggle to keep it. We're going to build a modern version of that system next, something that keeps the discipline but works with today's tools. But first, we need to talk about the traps, the subtle ways modern systems encourage you to spend without thinking, because once you see them clearly, you can't ignore them anymore.
All right, you know the history, you know the problem. Now let's talk about the advanced traps, the ones that don't feel like traps because they've been dressed up as features, rewards, and smart financial tools. These are the ones that catch people who already think they're being responsible. Trap number 1, the overdraft protection fee. Notice the word protection is doing a lot of work there. Banks market overdraft coverage as a safety net, when in reality it's a large penalty for a small mistake charged by an institution that could simply decline the transaction for free. They approve it, let you go negative, and then charge you for it. Trap number 2, the rewards credit card. You get a small percentage back on purchases, which sounds appealing, until you realize the average credit card interest rate is extremely high. Many people end up paying far more in interest than they ever earn in rewards. Trap number 3, the minimum balance requirement. Some accounts waive fees only if you maintain a certain balance, which defeats the purpose for many people who are trying to build savings in the first place. Trap number 4, buy now, pay later. Splitting payments makes spending feel smaller, but the total cost is the same, and missed payments often come with penalties. Trap number 5, the free checking account that isn't actually free. Fees are simply moved elsewhere: ATM charges, transfer fees, statement fees, or even inactivity fees. Okay, theory is done. Now it's time to build the system.
Day 1, open a separate savings account at a credit union or a different institution so it's not instantly accessible. Day 2, set up an automatic transfer, even a small one, to move money there on payday. Day 3, ask your bank what fees you're currently paying. Day 4, cancel one unnecessary recurring charge. Day 5, write down a specific savings goal with a clear number. Day 6, research an alternative institution like a credit union and compare costs. Day 7, add friction to spending. Remove saved cards or autofill to make purchases less impulsive. Do all 7 and you will have built a modern version of a much older, simpler system, one that makes saving easier and spending more intentional. If any part of this made you realize you don't fully understand how money works, that's exactly why the ebook exists. Finance Literacy for Beginners explains budgeting, saving, debt, and how financial systems actually operate in plain language. Here's the truth to leave you with. The people who used these older systems weren't necessarily smarter. They just had a structure that made saving the default and spending require effort. You can build that same structure today with better tools and more security, but the principle stays the same. Print the checklist, put it somewhere visible, do one step today, not perfectly, just consistently. The best system is the one you actually use.